Hi everyone, I'm Shawn Severson, CEO and Head of Market and Thematic Research at Water Tower Research. Welcome to this week's summary of our weekly commentary for the week of July 27th. Before I get into the 5 most important things from this week's market commentary, let me start where it counts with what to actually do with it. 3 reads to carry into the week. First, our read stays with the profitable, higher quality end of the market. It's the one place where price and earnings are both confirming, and last week the actual numbers backed it up, with 72 of 85 S&P 500 companies beating, and the beat rate strongest right at the top. Second, we're not chasing anything into this week's gauntlet. The Fed, the last 4 big tech reports, and the quarter's growth and inflation numbers all land inside about a 36-hour window. So we'd let that clear before leaning harder either way. And third, don't let the rate move scare you out of quality. The 10-year breaking above 4.5% puts things on watch, but the profitable small caps we favor don't really feel it until rates are sustained closer to 5. And the one thing that would change our mind is that level holding while the earnings breadth rolls over. Okay, here's the why behind all of it, the 5 things that drove the week. Number 1, the AI trade got repriced, but the earnings held. Alphabet actually beat, then fell almost 8% because it told the market it's going to spend north of $200 billion building out AI. Tesla missed on margins. And the Magnificent 7 basket is now negative on the year, even though most of them didn't miss on the top line. This wasn't the market marking down the earnings. It was the market rethinking what it will pay for the build-out. That's the whole story heading into this week. Number 2, underneath the giants. Quality won again, and this time on the hard numbers. 72 of 85 S&P 500 companies beat their estimates, and the beat rate stepped right down the cap stack, strongest in the large caps and easing as you go smaller. Defense, autos, and the financials all beat on real demand. For weeks, the quality red showed up in the price. Last week, it finally showed up in the earnings themselves. Number 3, the money finally followed. For a month, the frustrating part of this rotation was that even as quality led, the cash kept pouring back into mega cap tech. Last week that flipped. The money walked out of the NASDAQ and out of small caps both, but the important part is that price and flows are now pointing the same way on big tech for the first time in weeks. The contradiction that's been nagging at us cleared. Number 4, rates broke higher right into the Fed. The 10-year pushed through 4.5 up to about 4.7%, and the 2-year rose with it. So the near-term rate relief the market was leaning on eroded on both ends. Now here's the nuance we want you to hold on to. For the profitable small caps we favor, 4.5 is a watch level, not a wall. Their debt is mostly fixed and serviceable, and rates don't become a real headwind for them until we're sustained closer to 5%. For the speculative, unprofitable names, it's a different story entirely. Rates aren't what drives them. The cost of raising equity is. Number 5, this week is the widest test of the year. The last 4 giants, Microsoft and Meta on Wednesday, Apple and Amazon on Thursday, all report into a Fed decision Wednesday afternoon and the quarter's growth and inflation numbers Thursday morning. Everything inside about 36 hours. If the earnings hold and rates behave, the broadening widens past the mega caps. If they don't, leadership snaps right back to the top. That's what we're all watching. And before I let you go, a quick lightning round from our quick read, the 1-page summary at the front on the corners we didn't get to. On valuation, the earnings estimates kept broadening, running close to 2-to-1 positive, and the premium investors pay for the biggest names shrank for a 3rd straight week. In crypto, it actually broke away from stocks this time. It held while equities fell, and the ETF money came in the same week it left mega cap tech. And in commodities, oil ripped toward $90 on Middle East supply tension, but the longer dated contracts barely moved and stayed below 80, which tells you it was a supply scare, not real inflation. That's the week, the read up top, and the 5 things behind it. I'm Shawn Severson with Water Tower Research. Thanks for listening, and I'll see you next week.